When is the best time to buy real estate? Today, that's what we're discussing. Hi, I'm Tim Diesel. I'm a commercial real estate consultant. This channel is designed to give you tips and strategies in your investing business. If you're a broker, this will definitely help your clients as well. Let's talk about it. When is the best time to invest in real estate? I get this question a lot, especially right now, and I've been talking about it on my podcast a little bit. I've written articles about this, but this bears repeating, and it really is worth making a video about this for you. So, depending on where you live, the cycle, the asset class, what you plan on doing with the property, there's a couple things come into play. And really, I had a mentor tell me years ago, you buy when you can afford to buy. And I've always taken that advice because it's true. If you have money now and you need to deploy that capital, and the investment you're evaluating has a good return of 10%, 11%, don't sit on the sidelines because you think a better deal is going to come up. I've never believed in that philosophy. Even if you're right, if you're in the position to buy, you buy. If you've been on the sideline for 2 or 3 years, you're probably not a buyer, which is fine. You're just not ready to buy. But if you're actively looking and you're looking to buy, don't make the mistake of maybe this isn't the right time. What should I do? Should I be careful? If you do all your research and you have the right team and you're fairly confident when you close on the deal, you're going to cash flow for the long term, because a commercial real estate property should cash flow, right? Unless you're turning it around or building from the ground up or something unique. But for the most part, the day you close, maybe you have a few value add options or something like that. You're not really taking a nosedive on this thing. You should be in good shape. Now, if your plan is to get out of this thing in 6 months or a year, that's a little challenging. That takes a different type of philosophy, different type of game plan entirely. What I'm referring to is if you're buying a retail office building, a warehouse, apartment building, if you hang on to it for 3, 4, 5, 10 years, whatever the case is, in the long term, you're going to be just fine because you're looking at multiple ways of making money. You're not only getting money from the rents, the tax deductions, all kinds of appreciation. I mean, you really have a layered approach, and you're going to be insulated. You'll be protected. You'll be fine. All right, so what's really popular right now are hedge funds, syndication groups, crowdfunding, that sort of thing. If you're in a situation where, well, twofold, let's say you're investing into a group and you really need your money and you can't sit around for 3 or 5 or 10 years, whatever the group is, that's not very good. You should only invest capital that you could afford losing. And that's not to say you want to lose it. You just want to be careful and not be heavily dependent on it. Now, if you're taking someone else's money and maybe you borrow or they invest into $100,000 and they need their money now, and you have pressure from one party, you might fall into a trap of not making the best decision, liquidating too early, getting everyone paid back, cashed out. Those kind of situations can happen. Ultimately, that's selling too early. It has nothing to do with riding out the storm, letting things go. See, what happens a lot of times is most of these investors get into these investments and they don't have enough money to sustain the deal. So it'll go 1, 2, 3 years, maybe it'll go longer, and they have money tied up and they'll say, look, give me 80% of what I have in there. I just want to move on. I have a lot of other things to do. That's when you run into trouble. So if you avoid that and you're okay for the long term, you're going to be just fine. All right, and the last thing I want to tell you about this is be careful of how you're acquiring these assets. So I'll give you an example. Retail is not very favorable with banks right now. You're probably looking, I've seen 65, 70% in the market. I've seen 75 a few times. Multifamily banks are kind of backing off a little bit, especially hotels. They loved hotels years ago, 5, 6 years ago or something. And you have to be aware and cognizant of what's happening in the market with financing. Now, if you're paying cash, this isn't an issue. But if you have a 3-year or a 5-year fixed, and you know 3 years from now, if the rates go up, it's going to wipe out your deal. That's probably not a great deal to do. And I know the argument is that, well, if you do invest interest only, it's going to be better because you're going to have a lot of cash flow, and who cares if the rate goes up? You've already. That's good and well and all. There's another way to look at it. There's another approach. What I'm saying is, when you're underwriting the deal, make sure you have enough cushion to, if things go terrible or if things go, too wild for you, you'll be okay. Try not to put yourself in the position where if the market turns, you're gonna have a problem. If the market turns and your cash flow is still the same, but the actual asset drops in value because the interest rates are so high, well, you're all right. You can ride it out for a little bit. You see what I mean? You don't need to liquidate. If your cash flow takes a dip because your national anchor tenants are suddenly leaving, now you can have a problem, because a lot of these national tenants aren't what they used to be anymore. It's not very good. But at the same time, they still carry more weight than an average new business owner. So take inventory of what's going on in your neighborhood, obviously the economy, where you live, traffic count, all that fun stuff. Don't just go into anything ever, even if the market is great. You should always be careful and be aware.